I think gold is going to play a much bigger role. And actually, the reason why it's going to play a bigger role is because of the US dollar. Gold is a dollar hedge, and the Asians know that, and the Europeans know that. Actually, the Americans don't know that. And we're Americans, so we can say that.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abaxx Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here.
Welcome back to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abaxx Technologies. Our guest today is Tom McMahon, co-founder of Abaxx Technologies. We'll be discussing the ways in which the role gold may play in our financial system in the near future is not all that different from the one gold and silver played in the not-so-distant past. We'll also discuss how precious metals' role in the markets evolved in the latter half of the 20th century and what that may teach us about how the role of gold may continue to evolve in the 21st century. Hello, Tom. Welcome back to Smarter Markets.
Hey, Dave, thanks very much. Really happy that you gave me the second opportunity.
Oh, anytime. It's been too long. It's great to have you back on the podcast. And I always really enjoy talking with you, Tom, because I feel like your personal experience of these markets is often a history of the past few decades of them. And on this podcast series, we've been talking about how gold could move into the mainstream of our financial system in the future. And in many ways, this could be a more of a return to the role that it's played in the past, and not in the distant past, but to more of the role that gold and silver played when you started working in commodity exchanges, which wasn't all that long ago. So I was hoping you could take us through some of that history and of your experience of it. Maybe you could take us to when did you start working on commodity futures exchanges, and what was the role of gold and silver in those markets?
Yeah, actually, thanks, Dave. And I started when I was a kid, which sounds funny when most people don't come into the financial industry until their adulthood. I grew up in a commodity family, as we had spoken about earlier in our first podcast. My dad was a cotton trader, but he was also a member of COMEX. And COMEX, as we knew it, or as he knew it, I should say, back in the 1940s after World War II, was only trading silver. As we know that in 1933, Roosevelt took the United States off of the gold standard and basically confiscated all the gold in the United States and used it to pay off the national debt, which was quite unique. We could touch on that later. But for me, I was very lucky to be exposed to commodities from a family aspect, and my dad being a trader when I was a young boy in the New York Cotton Exchange. And in those days, Wall Street allowed for you to work in the summer times for 6 weeks a year. From the time you were 13 years old, you could be what was called a page or a runner. And it was both in the commodities and the stocks, on Broadwall or Exchange Place or Hanover Square, where all the different exchanges were. And so you got paid $100 a week, which was a fortune back in the late 1960s. My first summer was there in 1968, and I was a kid. The exposure was tremendous, and I went on to university, and I came out of university and went to work on the street, and that was in February of 1977, and I went to work on the New York Cotton Exchange as a phone clerk. At that time, with a company, it was a cotton merchant firm from Memphis, Tennessee, Hohenberg Brothers. A year later, they were acquired by Cargill. So the second part of my career was with Cargill for the next 5 years as both a phone clerk, a write-up clerk, a runner, and I became a member in September of 79 of the New York Cotton Exchange and July of 80 of the coffee, sugar, and cocoa. And again, that's the soft side of commodities. But the relationship for me was very much silver played a very strategic role in commodities up through the late 1970s with electronic trading of currencies, or even pit trading really in its earliest fashion, but then electronification. But Up to that point in time, when you traded a European contract, you traded either against a Deutsche Mark or a pound. And at that time, they were backed by silver. And what we know is pound sterling was backed by sterling. And so if I traded a sugar contract in London, I hedged it with a pound sterling contract. If I took delivery of a contract out of London or an overseas delivery in cotton, even, we used silver as the hedge. And one of my very first jobs was as a runner. I would run silver certificates between COMEX and New York Cotton Exchange Clearinghouse and Chase Manhattan Bank and JP Morgan. Either we were taking or making deliveries. And this was really before the heyday of treasury bills as we know them today. You had a bond market, 30-year bond market. And mostly at that time, you had interest rates of about 3% on those bonds where you used silver as your collateral. And we used silver in the cotton business. So I learned how to run COMEX relative to using cotton and silver certificates, warehouse receipts as our collateral. That was in the late 60s, early 70s. And then 74, when gold began retrading, it allowed for gold to be starting to supplant that position as the collateral. It became a bit more efficient. Instead of having 5,000-ounce bars, you had 100-ounce bars. And the scale of the metric where silver was trading $5 to $6 an ounce. And at that time, gold was in $130 range, which we know changed significantly. By 80, 81, you had gold in the $800 range and you had silver in the $50 range. And the markets that sort of set the tone for the markets going forward. And as we know today, the market's significantly higher. But the role that it plays, really ex-US, is probably the more important role for gold because they never, ever had the issues that we had, or the de-education, as I call it. I could tell you when gold started trading again in 74, it was like a trinket. People had no concept of it as a business tool. And it took a lot of time to really start to come on as a true inflation hedge, as opposed to just a speculative part of a portfolio. But it's changed even in those years from 74 to where we are today. And I was just reading an article yesterday too about the treatment of gold in the liquidity pools and how banks can use it as an asset and how it's proving itself to be at times even more liquid than the treasury markets today. And so there's an argument under Basel and AMIR to change the nature of gold in terms of how it's managed in portfolios and financing and how the bank can put it on balance sheets and treat it equally. So, yeah, gold has changed over time, and as it has for me too. And I've been very fortunate enough in a number of the exchanges. Obviously, my experience on NYMEX and then COMEX, I was a director of NYMEX, late 80s and early 90s. And at that time, the fortunes of COMEX had dropped significantly. After gold's great run in the 80s, the markets for metals were significantly challenged on into the early 90s. And by that time, COMEX was looking for a savior. And it was NYMEX. And at that time, the fortunes of NYMEX had changed dramatically because I can tell you in 1981, 82, NYMEX was almost bankrupt. It wasn't until 83 in the trading of oil that it changed its fortunes. And 10 years on, it was a much wealthier exchange than COMEX. And in 1994, it allowed for NYMEX to acquire COMEX. And that in and of itself was very interesting because now you had oil and gold tied together. And so you had a bit of a seamless trade within the same building initially when we still had floor trading activities and electronification subsequently to that as NYMEX was acquired by the CME and it migrated onto Globex, expanded significantly the role that gold played in terms of a tradable instrument within the commodities. So, and now that opportunity is for Asia. The vision that Asia has for gold is very different than North America and different than Europe also too. It's culturally, it's much more ingrained, even down to the lowest nth. I mean, you can track like a country like Malaysia, 34 million citizens, and the average holding per year of purchases of gold is 32 grams of gold, every family. Now, doesn't sound like a huge amount of metal, right? When you're talking about grams, but grams traded at a huge percentage to physical metal. So you're buying a gram of gold anywhere from a 30 to a 40% premium over. So it becomes a business when people can take it down to those levels, but people acquire it to hold it within their portfolios. And it's very significant in the farming economies. When a farmer needs to get his seeds each planting season, they have a program in Malaysia called Aranu. And Aranu is a borrowing and lending program through Islamic lending that uses gold as its collateral. key to it is that when you deposit your gold to borrow, the gold that is returned to you is your gold. So it's never somebody else's gold. It's very, very specific and very unique in that system. If you give them a 10-ounce bar, you get your 10-ounce bar back when you pay your debt back. But you use those funds to buy seeds for your planting season. So it's got a very organic use case in the agrarian economies across Asia, all hedgeable and all with very, very clear demand outside of the speculative interests. So that's the markets that we see, the potential. You've got India alone, 1.4 billion people. And by nature, it's a country that owns gold, even down to the poorest person. China, similarly, a different vein of how the Chinese gold is part of the monetization. It's not obviously not within the renminbi system, but it sits right alongside of it in a parallel universe of purchasing power and lending power. You can definitely see that in Hong Kong. It's very clear. You walk down the streets and you see the gold stores one after another. And now in the Middle East, similarly, we're seeing that. You got gold vending machines, which is a bit far out there, but the reality is there are people that buy bars and vending machines today. So it's an interesting opportunity for us for the marketplace that's opening up. But again, very culturally diverse in how gold is acquired, held, or utilized.
And there's so many aspects to what you just said that I'd love to dig into with you. And maybe I'll start. There's this wonderful distinction between how people in the US and Europe are accustomed to thinking or not thinking about gold versus those, as you said, more in Asia, where it's much more kind of ingrained in daily life. But I wanted to start, maybe go back to that point in the 70s where you said people needed to be de-educated because now probably there's going to be a similar de-education or re-education. And so I wanted to ask you when the US moved off the gold standard and there was the end of the Bretton Woods currency system, how did that affect gold and silver and what was that de-education process like for people in the trading and clearing business?
I think for me, again, because I had gotten exposed early on what you did with a silver certificate with a warehouse receipt. And to me, it was a commodity, just like if I had a cotton warehouse receipt or an OJ warehouse receipt or a bushel of wheat and a silo receipt, I had a silver receipt. I thought it was very normal. It was not. It's what I came to learn because people looked at metals were mysterious to North Americans, not so much Canadians, because even actually in Canada, it's really a commodity and you've got the Royal Mint and everything. It's a little bit different there. But in terms of a business use case and stuff, Americans were mystified when gold reopened. And the people that utilize silver, like ours, interestingly, by the mid to late 80s, use case of the dollar in Europe had changed dramatically after the introduction of the petrodollar. Prior to 77, 78, you cleared Europe, you cleared either pounds or Deutschmarks or French francs. The euro hadn't even come about yet. It was just a twinkle in people's eye. The dominant currencies were Deutsche and pounds. And so you still had a sterling hedge. You still had silver as a hedge against the currency hedge. So interestingly, when LCH changed and went to dollar clearing, it had a very dramatic effect on the silver market negatively because suddenly people was like, what do we do with it? It really had no industrial use case. But gold went the other way. Gold suddenly became very important because of the BOE and the LPMCL, the London Precious Metals Group, well, the six banks now. And it's varied over time, but the BOE so the BOE uses their gold. It is a strategic use case of borrowing and lending, leasing of gold as opposed to Fort Knox, even though the US has still got what's supposedly the largest stores of gold in the world, they never use it as the Europeans do. So gold has still got a very different use case in the US. But if you go to Canada, you go to like RBC, Royal Bank of Canada, they have a gold lending program. And I know the guys that ran that program actually in New York City in the old Merrill Lynch building on Liberty Street. It was one of the most vibrant lending facilities in the world for precious metals. And most people didn't know what to do with it, interestingly. So I think that's changing dramatically now. We're seeing the rise, well, obviously the rise of real interest rates, but you're getting a re-education on what is the collateral underpinning that the US dollar is getting challenged. And that period of the petrodollar. And I think you got to really pay attention to that because the rise of the petrodollar changed the nature of the US dollar dominance. Obviously, it became the dominant currency. Prior to that, it was not. It was an important currency, but between end of World War II and the Nixon era, it was really the rise of the petrodollar that changed that dramatically for Europe. So then gold got priced in dollars. That's pretty much the most significant change. And suddenly COMEX became a much more important or intrinsically important hedging tool than it had been prior to that.
And you mentioned with COMEX coming under the NYMEX roof, and NYMEX, of course, being so important, and when it kind of reemerged from its troubles in the late 70s to become the preeminent energy exchange. How important was having gold and oil under the same roof in terms of an exchange and clearinghouse?
It took a while. Again, people treated gold still almost as a secondary speculative hedge. It wasn't really truly. Silver became actually more of a use case with the rise of renewable energy. Silver got a reinvigoration. At the same time, it almost got destroyed because with the bankruptcy of companies like Kodak, the traditional film industry, with the rise of the digital film industry, suddenly silver had lost a real industrial use case. And then suddenly it shifted again to the rise of renewables and similarly the rise of the handheld technology. So silver suddenly became an industrial demand. So actually silver became more important for the NYMEX-COMEX relationship and copper also. Copper was a contract that tagged along with that acquisition. And especially with the rise of China post-2004, an interesting point, I don't mean to diverge away from, but it's relevant to how you can get a significant industrial or regulatory change that will have a massive implication on the commodity. In 2004, China made a decision within the construction industry because of the cost of copper was so significantly higher than aluminum for the Chinese. After in the 1950s, under Mao, all construction wiring, building wiring was aluminum. By the early 2000s, it had become basically a disaster. Aluminum wiring deteriorates rapidly and it becomes a fire hazard. So they made a strategic, they said, okay, listen, we all wiring from January 1st, 2005 will be copper. Well, the price of copper in like June of 2004 was, I'm going to say $55, right? And I think I'm wrong. It was a lot less than that in terms of US costs. And I attended a conference in China, and there was a gentleman who was the head of the World Copper Council. Never knew there was a World Copper Council till then, but similar like World Gold Council, there was a World Copper Council, and he spoke about this regulatory change for China. And the Chinese realized they did their math. All they did was look at the building permits for Shanghai alone for the next 2 years. And they realized that all of the material in the current LME warehouses would be consumed in the next 24 months. Copper tripled in value overnight. You've had similar issues with silver, and solely based on China on solar panel production. And for silver, it's silver paste. And there are certain companies, mostly Japanese companies, that create this silver paste. And silver paste trades at a triple to what underlying silver trades. So if silver's at $30, paste is at $90, and other kind of thing. It's a massively, but again, it was an economic regulatory change in China of going from traditional energy to renewables that created this demand for silver. Now, gold all tags along behind that is really the use case there. And that's what we've seen over the years.
When you think about, you'd mentioned that the Bank of England has always used its gold, leases it out. US, it's been less that way. How does that affect the participants in the gold market, in the silver market, and how that was structured and traditionally has operated?
Interestingly, US has gold mines, but they're not primaries. So most of the gold production in the US actually is secondary to copper or recycling and such. But if you look at COMEX, and if you look at where the bars come from, it's very interesting. A large part of the, I shouldn't say a majority, but a large part of the supply chain for the 100-ounce bars that are COMEX good delivery actually come from Japan, from recycling firms in Yokohama. that create these 100-ounce bars out of this incredibly efficient recycling industry and scrap industry here. I happen to be in Japan, so I can say here. And it was very interesting that a lot of those bars, but there are legacy bars in the US too. There are bars that you can go into some of the vaults, like the ones that used to be they're inside the Fed, but over on Nassau Street, a large part of that used to actually be in the Chase vaults before ICBC acquired the building. But some of that gold goes back to 1933, those 100-ounce bars, and they've got a bit of a different color to them just because it was the copper content was a little bit higher at that point in time. But those bars are very unique. They came from the 32, 33 Roosevelt. Basically, all the gold had to be turned in and gold certificates were destroyed. That metal still sits within vaults. More interestingly, a large part of the actual physical gold, not bar metal, but coin metal, is actually in Paris. Because in 33, when Roosevelt confiscated all the metal, he did it at a fixed price of $16. I think $16.50 was the price. And on the fixed day in 33, when all the gold had been taken in by the Fed, they turned around and doubled the price of gold overnight. And gold went to $33, 33, 34 as we knew it, all the way into 1974. And the reason was that we owed, at that time, billions to Europe, to France specifically. And we basically halved our debt overnight by doubling the price of gold and sent these coins to Paris. And you can still find them there today. You can still find $20 St. Gaudens Standing Liberty dollars in the Paris banks that they periodically send back to the United States at a huge premium.
I guess that was part of the rise of the French discussing the exorbitant privilege that the US would start to enjoy being the reserve currency. And I wanted to ask you, kind of bringing things back to today, how does your experience inform how you think about the role of the US dollar today? And in particular, as the British pound was challenged in the past and kind of went from being the international clearing currency to not being the international clearing currency, do you see the US dollar being challenged?
I really don't, not to the extent that people would like to see it collapse and disappear. I think the problem, that's a terrible word, problem. From an Asian standpoint, it's a problem. Why is the US dollar the preeminent currency? Because it prices commodities. That's what I think people completely miss. The US dollar, prior to the mid 1970s, prior to the reopening of the gold market, prior to the pricing of oil in 75, 76, the rise of the petrodollar, which was only supposed to be a petrodollar. It was not supposed to extend itself into pricing beet sugar from Germany, which it does today. That I really do not see changing. As much as the Chinese or the Japanese would like to see the yen or the renminbi as a default settlement currency, it doesn't have any dominance in any single commodity anywhere in the world. It's US dollars do. And even new commodities. I mean, look at Bitcoin is priced in dollars. It just happened. And it was actually the Chinese who did it. I happened to be out here at the time watching back in 13, 14 and seeing the rise of, the BTCC, what we know today is ByteDance and Binance and OKEx and all these guys that were coming out of China. It was the perfect dollar swap for them, right? Unless you find something that's going to replace a commodity settlement currency or utility. I don't see the dollar going away.
And why is that role in commodity settlement and clearing so important for people who, a lot of folks, they don't look into the plumbing of the system the way you have?
It's long enough in the past, even for me. I mean, I'm not a kid anymore, so I've sort of spanned a number of decades. I talk to people in business today that they didn't know that LCH didn't used to clear US dollars. I mean, you talk to somebody about the history of clearing. LCH is the dominant English clearinghouse. It's had its ebbs and flows over time, but there was a time it didn't clear dollars. Really? No, no way. Yeah, it didn't. And, the French didn't, right? Matif, the Paris exchange didn't clear dollars. So the banks had an intrinsically important role as the currency swap protagonists, right? And that was a banking job. I mean, the FX guys, it's interesting. If I go back even to 1990, 1990 was a very interesting year because that was just prior to the first Gulf War. And the richest guys that I knew at that time, it was just at the end of the Drexel era, right? Rudy Giuliani was sending Michael Milken and all those guys to jail, right? But the richest guys I knew on Wall Street were not commodity guys by any means yet. They have become that significantly. But it was the bond guys, the bond traders, they were the kings. And then behind the bond guys were the FX guys, the guys trading the currencies who had the spreads, right? And they controlled what was your yen dollar swap going to be today. And then subsequent to that, it changed dramatically with the rise of electronification, systems like Globex and things like that, the consolidation of Europe, the rise of the euro and the EU as we know it, right? And the regional exchanges going away in Europe and consolidating into what we know Euronext Life and the acquisitions of like the IPE and things like that. Over time, the dollar just got more and more and more consolidated in its power. And who were the power kings? And you look at firms like in the US, I mean, today we look at Citadel or Virtu or Sequoia. Actually, the guy who set the tone for all of that was Paul Tudor Jones. Paul Jones. Paul was a cotton trader. Paul came out of New Orleans, right? Traded on the New Orleans Cotton Exchange. Was brought to New York by a gentleman named William Donovan, Billy Donovan. Got into the cotton pit. The rest, as you could say, is history. But he was brilliant. He still is brilliant. But you look at the wealth and you look at the funds and the structures that he set up today. People look at like Steve Cohen and go, they modeled themselves on Paul Jones. All the roots were all in commodities and the roots were all in dollars. So I know it's a long way from where we are, but that's really where the roots came from.
And when thinking about the future, sounds like you don't see the dollar being challenged, given the kind of entrenched role it's taken on. What do you see potentially as the role for gold and precious metals moving back to more of the mainstream of the financial system? And is that different between the more Western countries versus Asia?
I think gold is going to play a much bigger role. And actually, the reason why it's going to play a bigger role is because of the US dollar. Gold is a dollar hedge, and the Asians know that, and the Europeans know that. Actually, the Americans don't know that. And we're Americans, so we can say that. Yeah, it's very interesting. Try to explain, and there are a lot of gold nuts in America, some really great people that I've known over the years. It's very difficult to try to explain. Americans don't realize that their currency depreciates 2% every year within 10. That's built into the treasury, right? People like, no, I can still buy stuff with my dollars. That's okay. That's just domestic bliss, right? And unless you travel outside the United States or do business outside the United States, you don't really realize the impact that it has. Gold is that hedge, all right? I mean, for me, I've lived in Asia over 20 years now. I've owned gold the entire time, and I've probably negated all of my dollar losses just by owning that metal. Just slow creep, just balances out, balances out, balances out. Asia's starting to discover that if they want to de-dollarize, it's not Singapore dollars swapping renminbi. It's Sing dollars owning gold and Chinese owning gold and using gold as that bridge, potentially as the hedge instrument, as opposed to just swapping renminbi dollars or renminbi Sing dollars. So gold is going to play more and more of a role. And also too, it plays that security role. People always go, in times of war and times of strife, people have always gone to physical things, right? I mean, diamonds and gold and stuff like that. And then people are like, oh my God, yeah, but you can't carry a ton of gold with you when the world goes to hell in a handbasket. Well, you don't have to anymore. You've got secure vaulting systems and you've got connectivity globally, right? Or in the case of Singapore, Singapore has built a vault over since 2012 efficiently, using LBMA good delivery standards and allowed for private businesses and for single family and multifamily offices and for international banks to build a portfolio of metal within the country. The next step is the unlocking process of how you can use that as a hedgeable instrument, right? As a collateralizable instrument. It's going to be very interesting.
Yeah, and that brings me to the next question I wanted to ask you, Tom, which is traditionally when we think of global gold centers, it's New York, London, with so much more of a role for gold in Asia. How do you think about where the next gold center or centers could be located, and what determines that?
Good question. Obviously, political stability is very important, right? If I'm going to store my metal someplace, I want to make sure it's not going to be taken over. Unfortunately, historically, there's been periods of time where gold is one of the first things that's grabbed, and then people spend years looking for it afterwards. That's interesting. If you're sitting in Asia, by default, it was Hong Kong that played that role for many, many years. Unfortunately, it's lost that role because of the rise of China's security law. Also, people just don't have a sense of confidence that they had previously, where Singapore has now taken on that role. And they did it with intent, and they did it with a very good legal structure, very good tax structure, and also a very cooperative structure with the European markets, the Swiss refiners, and with London, with the LBMA recognition of their good delivery standards and refining processes, and with specific vault operators, the likes of Brinks or Malka Amit and such, Loomis. Cooperatively, they built a very robust, secure architecture around the international airport system in Singapore with good consumer protections also and legal rights of transference of metal. So you'll see more and more of that. Interestingly, if you look at Japan or Korea, who are historically, there's a culture also very astute in owning metal, but very, very inefficient tax architectures as a result of it, very high costs. So you look for efficiency around tax, ownership, legal security, vaulting, and but at the same time, you want to have a financial community that you've got a trading infrastructure embedded in it. So we've seen that. Australia similarly too. Sydney and Perth, you've got trading communities down there that are historic as a result of the mining industry, mining and mineral industry, but they're mostly on the supply side. They're net sellers to the world or to Asia. We're seeing, again, we're seeing Singapore as a centrally located, secure environment. Similarly, we're seeing that in the Middle East also, mostly in Dubai. It has grown up, but Dubai has a challenge. It doesn't have the recognition of London. So you've got the good community, you've got refiners, you've got traders, you've got supply and demand, but you don't have the legal form that would sort of give it the stamp of approval. So that's always been a challenge. So it attracts a different set of investors as a result of it. Doesn't necessarily mean they're negative, but it definitely has a different flavor in terms of who the market participants within that region.
And there's so many ingredients that all have to be there to make these markets work. And you had mentioned that with Singapore building the vault structures and taking the steps they did, then the next would be how do you unlock that metaphorically? What did you mean by how do you unlock it and what does that look like?
And it comes down to how do you treat gold? And again, if you go back to the American concept of gold, I know that I'll use my mom as an example that in 1974, when gold reopened, actually there was no supply of gold in the United States. It was interesting that when gold began to free trade, the first supply of gold into the US were Krugerrands from South Africa. That was the gold trading instrument for a number of years. Because even though gold was free trading, they did not open the vaults. It wasn't that the US government issued new gold or anything as such. It subsequently has. The mint has numismatically, but not as currency, where the Krugerrand was actually a currency from South Africa. And I remember my dad acquiring one for my mother, and it became like an incredible keepsake for her. And she put it on this beautiful chain, and she had that for many, many years. And so again, even though gold was free trading, it was still treated as a unique instrument, nothing from a business concept. Asia is very different. Gold is obviously an investment, but it's a utility also. You've got a medical industry and a jewelry industry of robust size out here that utilizes gold on a regular basis. So you've got real industrial demand, but you also have investment demand. The Asian banks all have bullion trading desks embedded in them. It doesn't necessarily mean they're efficient, because I think for a number of the banks, they actually are very high profit centers simply because of, again, there's a lot of opacity in the price of gold, and especially depending on the size. The most efficient size are either kilos or 100-ounce bars or 400-ounce bars in terms of London. That's where you get actually close, the closest to the purest price of an ounce of metal or a gram of metal. Everything beyond that has huge premiums built into it. So ignorance is a bit of bliss for people when they buy a gold ring or a necklace or whatever. And it's the reality is that when you go to sell it, there'll be some intrinsic value, but for the most part, you're going to sell it for the weight. And most gold industry know that. So you sell it for $1, you can buy it back for 50 cents, that kind of thing. So that's changing. We're seeing that change. And I think going back to the dollar or de-dollarization, Singapore, just as an example, the rise of the single family office. And again, the Singapore government did it with intent, attracted high net worth individuals to the country to set up their family offices. There's over 2,300 family offices in Singapore now. 10 years ago, there were literally 300. Dramatic change. And that's single family offices. There's also multi-family offices that go beyond that. And it draws wealth from all over the world. What are they doing in Singapore? They're investing not just in Singapore, obviously. Singapore's a tiny place. It'd be difficult to only invest there. But they're managing their portfolios from Singapore. And pretty much every one of those portfolios today has a precious metals investment in their portfolio. And that's an important part. These people want to be serviced efficiently. So the opportunity in Singapore is they've built this infrastructure of both tax, ownership, security, and now the trading infrastructure is being built around that to service that industry and create a liquid market that could be converted either on the buy side or sell side efficiently. That can be converted to whether it's any one of the currencies. And that's the thing too, is you can get a price for pretty much all of the major Asian currencies against your metal in Singapore in real time and get a settlement at the bank in real time. Equally too, you can purchase metal digitally, right? You've got people swapping digital currencies against gold as an underpinning.
Well, I want to thank you for joining us today, Tom. I could listen to you for hours, to be honest. I want to ask you one more question before you go, though. And that is, when you look out at the gold market and the greater role it could play in our financial system, the role it's increasingly playing in Asia, what do you see in terms of how the infrastructure of the gold market may need to change and evolve to be ready to play that greater role?
I think it's got to be generational. I think gold has been stuck in probably 3 generations in the last 100 years. And again, if you look at America up to 32, 33, it had one idea of what gold was, and then a gap of 40 years of no gold. And now the new metal, and it's still not a mature vision. Where European vision on metal is it's very conservative, it's very commercial, and where Asia has got a very, very different working relationship with gold. It utilizes metal, as I said, industrially, commercially, as an investment for portfolios, as a currency hedge, as a security hedge. So they treat gold very, very differently across all the different cultures. So no hesitancy of ownership in Asia, still a bit of an education in North America. Europeans are still going to be very conservative and think that, interestingly, Europeans think they own the gold market. That's a fact. I think it's changing. It's really the Middle East and Asian markets that are going to dominate metal in the next decade. Really, the key is the generational shift. I think young people actually understand the value of something shiny as well as something that's digital. I can't get a 40-year-old to buy an ounce of gold, but I can get a 20-year-old to do it. If he can buy it with his ETH or Solana or with something like that, they'll say, yeah, I want to own some of that. Give me some of that. And I can trade it. So we're seeing liquidity build in that generational shift also. And I think that that's going to scale in time.
Thanks again to Tom McMahon, co-founder of Abaxx Technologies. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abaxx Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here. Contact us at sales@abaxx.exchange to get started. That concludes this week's episode of Smarter Markets by Abaxx. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abaxx Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.